Was there information on sharing of salaries? Do you have information on sharing of salary to know how much Benson is Maker is getting and how much Janice is getting? Very fast, we'll flip on that. Is there any information that we've been told? Is there information that we've been told? Yes or no? Before I tell you, very important when you're doing anything. It's not about the answers, Benson. When it comes to these calculation subjects, the process is more important than the answers. Together, the process is basically more important than the answer. Are we together, Benson? So what I'm looking for, I'm not looking for, even today, one thing that I must tell my students that I'm not looking for you to be perfect, but I'm looking for you to make as many entries as possible. Is there any information on salary? That you're being told the salary is shared, this and this. Do we have any information on salary? So if there's no information, how do you share the salary if there's not such an information? You share it equally. So the salary, if there's not that information, this is for 15. We have for 15. Together. I want to sort this question, then we proceed to the next thing. So if there's not an information, Robert, then that should be shared equally. Again, do you have interest on capital? Do you have interest on capital? Do you have interest on what's called on capital? Do you have interest on capital? Yes, perfect. But I want us to read that statement. Don't say anything, but we read that statement. So the capital contribution was in the ratio. Capital contribution was in the ratio. So this is Maker. And on the other hand, we have what's called Janice. Maker and Janice. So the capital contribution was in the ratio of 1 to 3 to 1. So implying that the total ratio is 4. Maker gets 3 over 4. Janice gets 1 over 4. Together. John is not a partner. John got as a director. Are we together? John is not a partner. Anybody sign? Are you seeing what I'm saying? John is not a partner, but John is a director. Tuko pamoja. Is John a partner or a director? John came at the time of formation of a company. And so John is a director, but does not fall under partnership. Give me yes if you're together. Perfect if you're together. So then we proceed. We have the information on the contribution, implying that Maker contributed 3/4 of the money, while who? While Janice basically contributed 1/4 of the money. You gave me yes. While Janice contributed what we call 1/4 of the money. So then we proceed on that information. The partners were entitled to interest of 10%. The 12 partners were entitled to interest of 10% and 8% respectively. So interest on capital for Maker, that is 10%. Interest for Janice, that's 8%. That is 8% together. So interest on capital for Maker, we have a figure of 8%. Then interest on capital for Janice, we have 8%. So the next question that we're asking is how much is the capital? How much capital was contributed? How much capital was contributed? Are they split the capital, or we have the whole capital as a whole? Is there a split on that capital, or we have the figure of capital as a whole? That is the question. The figure for the capital as a whole, or the capital has been split? What is the figure for the capital? The figure for the capital. What is the figure for the capital? Tim. 6.8. And then as you say 6.8, you tell others where it's found. Others may not be seeing where 6.8. Where do you get the 6.8? Where do you get which additional information? The first information. So the first information that is being, Janice, Mecca and Janice have a running partnership by the name, what they call Jaka Enterprise, by the name Jaka Enterprise, by the name Jaka Enterprise. From 1st January 2023, they share profit and loss equally, so we can get the profit and loss equally. They share the profit and loss equally, having contributed a capital of 6.8. So this 6.8, 6.8, Mecca has contributed 3/4, while Janice has contributed a quarter. Together, Mecca has contributed 3/4, while Janice has contributed a quarter of the money. So interest on capital for Mecca, we have Mecca will be 10% times 6.8. I put it million, then times 3/4. That is the interest. Then for Janice, when I come to Janice, I'm having 10% times 6.8 times a quarter. So what is the interest on capital for each partner? Tafadhali, interest on capital for each partner. Karibu Rafael. Karibu Rafael. On neutral vector, Karibu. What is the interest on capital? Provide for me the interest on capital. No, we just started. I'm finishing on 2024. Yes. What is the interest on capital? Calculate for me that. Then again, because of time, you also try. So 510. What is 510? Then it's 510, but remember, was it for the whole year? It was there for 8 months, sorry. There was 8 months, 8/12. We've forgotten. Partnership was not there for the whole year, but partnership was there for 8/12. Is that understood? I did that deliberately for somebody to tell Mwalimu, you're lying. So partnership was there for how many months? 8 months. So the interest on capital was essentially there for 8 months. For 8 months. Ida and Robert and Victor Sahin, tuko pamoja. Tuko pamoja. So give me that times 8/12 for both, because the partnership was there. So we have 340. We have a figure of 340. What about for Janice? Janice, what is the figure for Janice? Janice, what is the figure? You're the ones holding me. You are the people holding me. Tafadhali, very fast. I need you, Tafadhali, to give me that figure. Get for me the figure. In the next 7 minutes, should be. Is that the figure? Look up at what? 6.8 times, this is 8%, sorry. This is 8%, sorry. Apple, interest on capital is 8% for Janice. Angalia additional information, 8%, not 10%. We've been told 8%. We've been told 8%. 8%. 8%. Angalia hapo, additional information number 6. So Janice is 8%. Don't use 10. If you look at additional information number 6, that is a figure of 8%. So 8% times 6.8 million times a quarter, that should be 90, 667. 90, 667. So give me the total very fast. Tafadhali, total very fast. Add for me those two very fast. Add for me those. I need to do something today. So we're having a total of 430. We're having a total of 30, 667. Tumelawana. I want to ask a very fundamental question. Hello? Yes, Sahin. Proceed. That is 2020, August 2020, August 2025. Partnership for the August 2025. Allocation, the taxable income for each partner. Together, Sahin. Give me a yes, kindly. So I want to ask you questions very fast, and those questions should be able to give me. Is there commissions to partners in this question? Do you have commissions to partners in this question? Do you have commissions to partners in these questions? Do you have commissions to partners in this question? Do you have interest in drawing to partners in this question? Do you have interest in drawing to partners on this question? We don't have. So there's not, we just have share. Down here we have share of profit, share of what you call profit, so what you call loss altogether. Share of profit or loss. So what is the taxable operating income? Taxable operating income. So the taxable operating income for this particular question, we had it as 4 million. I know most people did not calculate. 37 to 97. 137 to 97. So we call this B, and we get this summation, we call it A. So I want us to get C, which is a profit or loss share. So how do I get the C? The C, I'll get the total taxable operating income, which is B minus A. So what do I have as the share of profit or loss? If it's positive, then that is a profit. If it's negative, then that is a loss. Tafadhali. If it's a positive, then it's a profit. If is it a profit or a loss? Is it a profit or a loss? So get for me the figure. This minus the summation of the two. My people. Changamutu. Right now, you know your teacher, so we should have gelled very fast. We should have gelled very fast now in terms of provision for that. So what do you have? So we have it as 2806 630. 2808. 28. Somebody just to repeat it. Umwalimu. So we have 2806 630. 06 630. So how are they sharing profit and loss based on that question? Very fast. How are they sharing profit and loss based on this particular question? So it's a profit. How are they supposed to share it? What is the examiner telling us in terms of sharing profit or loss? In this case, it's a profit because that's not negative. So how are being told the first statement? How are they sharing profit and loss? How do they share profit and loss? How do they share what they call profit and loss? How do these guys share what they call profit and loss? So in the first statement, we have been told that they share profit and loss equally. Divide this into two. They share it equally, meaning profit and loss are half. So what does Mika get? Divide that figure into two. What does Mika get if you divide that figure into two? So 2806 630 divided by 2. So I have 1403 315. So I have 1403 315. Tunaelewana. So what is the total taxable income for Mika? Add those. Add this ones and get for me the for Mika. Tafadhali. So usiache mwalimu peke yake, support mwalimu by making sure that you do that. So this is 29, 21, 93, and then we have 315. So the other one we have for 50, so that we don't take a lot of time here. This is 19, 43, to go south. So how many marks was this question? How many marks was this particular question? How many marks? Very fast. I did 130 to pass before I started on what I'm doing today. How many marks? Very fast. How many marks? 3. This one requires majority of the students will not get these answers. Saying majority of the students, in most cases, you'll not even find one student getting this. But how is this distributed? 1, 2, 3, 4, 5, 6. So any 3. If you have this and this, and this you have. So any 3, this. Just understand that any 3 times 1 that will give you 3 marks. 3 marks. That's why the entries are very important. Then the last part of it, I hope that is understood. The last part of it. So being told to find what? Compute the tax payable for JK Limited. So JK Limited is this. So tax payable, this is the easiest. Tax payable for JK, that should basically be what? You just say 30% times 741,064. But the marking point is not this. The marking point is students understanding that companies are taxed at 30%. So the marking point is not getting the figure, but the marking point is essentially on this value, understanding that companies are taxed at 30%. I hope that is sorted. Tafadhali kama tuko pamoja, tubonyeze yes. Are we together as I get some data? So I'm done with partnership. Is that understood? I'm done with partnership. So I want to go to limited company. Taxation of what we call a limited company. Taxation of what we call a limited company. How do you tax limited company? So that handout, open taxation of a limited company. Do we have taxation of what we call of a limited company? Taxation of what we call of a limited company. Taxation of what we call of a limited company. Do you have the handout? Open the handout. We open that handout. Are we on it? Taxation of a limited company. We respond to the yes if you're there. Taxation of a limited company. Taxation of a limited company. So we talk about taxation. Taxation of what we call of a limited company. Together. Taxation of a limited company. Somebody to share the handout. Robert to share the handout from the group. Taxation of a limited company. Very fast stuff for that. I don't want us to waste time, kindly. I don't want us to waste time. Sitaki to sign. Kindly forward the handout on capital allowance. Our time is limited. Not a mass representative. Robert, share that handout for me. It's not the work of anybody who can share that handout. Let's share it very fast. The taxation of a limited company. Some of the areas that I'll be very keen on is corporation tax. Some of the areas that I want to is area of corporation tax. We will touch on what's called the installment tax. Installment tax. Are we together? We will touch on the installment tax. Taxation of groups. Taxation of what we call of a group of companies. Of what we call companies. Taxation of what we call of a group of companies. taxation of a group of company. We have head office, and what we call the branches. So how do you tax parent company? How do you tax the subsidiary company? What is corporation tax? What is installment tax? We are going to cover that. Then we are also going to talk about specialized. When you talk about limited company, and specialized will cover how do you tax the banks? Banks, we have insurance company. How do you tax construction company? Construction companies, etc. Are we together? Construction, how do you tax trust? Are we together? How do you tax the leases? Are we together? That is what's going to cover on that. Then you have shortfall distribution, what we call the shortfall distribution tax, and then we have what we call the compensation, what we call the compensation tax. Together, team, I want us to start with corporation tax. Corporation tax. So corporation tax. What is the corporation tax? And say corporation tax. Corporation tax. So remember, companies taxed separately as a separate, we call it separate legal entity. Company is taxed separately from the owner as a separate legal entities together. That is how we tax companies. Are we together? The companies are essentially taxed separately from their owners altogether. They're a separate legal entity from those who form it, from those basically say who form them. So in companies, very essential. The first thing before you even talk about corporation tax is determination. We call it determination of what we call of the taxable. Determination of what we call the taxable income. How do we determine the taxable income? We talked about this. We have the gross profit method, and then we have the net profit method. So we have the gross profit method, and then we have what's called the net profit method. So for the gross profit method, we basically use it when accounting profit is not provided. When accounting profit is not basically provided, that is when you use what we call the gross profit method. So for the net profit method, we use it when the accounting profit is provided. Understood? If that is understood, we respond with a yes. When accounting profit is basically provided, you give me a yes. You give me a yes if you're together. So in terms of companies, we basically have companies divided into two. We basically talked about resident company and non-resident company. For those that we taught on the intermediate, we understand what we mean by a resident company. When does the company basically qualify to be a resident company? And what criteria makes the company not to be a non-resident? So we have, in terms of companies, we have resident, we call it resident company, and then we have what's called non-resident company. So how do you tax resident company? How do you tax resident company? At corporate rate of 30%. This we tax at 37.5%. And that explains what we did on JK Limited. Why do you tax JK Limited? Because JK Limited is a resident company. A resident company we tax at corporate rate of 30%. 30% are together at corporate rate of 30%. Tubonyeze yes kama tuko pamoja. Tubonyeze yes kama tuko pamoja. Perfect. So when I want to talk about what's called companies in EPZ. Companies, we'll talk about companies. We'll talk about companies located call it at export. Export, we call it processing zone. So companies that are basically located at the export processing zones, and we call them the EPZ. EPZ. What is unique about these companies that are basically located? So you need to understand that at the back of your mind, that these companies, they enjoy what's called favorable. Favorable, we call them favorable. They basically enjoy favorable tax terms. Tax terms. So what are these favorable tax terms? What are these tax terms? Somebody says are exempted. No. When you say favorable, not basically exempted. Are we together? Exemption is also, a very powerful tool. If you're exempted, you're not paying tax. But you're basically saying that they enjoy a favorable tax terms. They have tax holidays. What are these terms? They basically have what's called the tax holidays. Issues to do with the tax holidays. They're given tax holidays for the first years of the operation. They're given a tax holiday. Then from the 11th year, we understand that from the 11th year, are we together? Tax at what we call at the rate. Instead of 30, they basically tax at the rate of 25%. 25% altogether. So for the first 10 years, they're basically granted what we call a tax holiday. Then from the 11th year, there is what's called a lower tax rate of 25%. And then we need to understand that dividends paid to non-resident, dividends, we say paid to what we call to the non-resident, we say is exempted from tax. Dividends paid to the non-resident is essentially exempted from tax. Dividends exempted paid to the non-resident is exempted from tax. These are some of the favorable terms that these companies that are located under what you call the export processing zone basically enjoy. We respond to the yes if you're together. Kama tuko pamoja, tubonyeze yes. We respond with the yes. If we are together, we respond with the yes. Sign tuko pamoja. Raphael, are we together? Perfect. Robert, are we together? If we are together, we respond with a yes. Then we have what we call additional allowable expense. Additional, when it talks about companies we have, as opposed to partnership, we have what we call additional allowable expenses. And these additional allowable expenses, when you say additional allowable expenses, these are expenses that we say can be deducted. These are expenses that we say can be deducted against what's called a taxable income. What are these additional expenses? So we have now companies, when you form companies now, we have directors. So we have directors, call it the director's fee. Director's fee. We have director's fee, remuneration, director's remuneration. We have compensation, etc. The payments that are now made to directors now becomes allowable. The payments that are essentially now directed to the directors now becomes allowable. Then we have what's called the cost of issuing shares, the cost of what we call of issuing, issuing shares. Issuing shares, that is what we call flotation cost. Flotation cost. Were we able to see this when you're discussing partnership? Were we able to see this when you're discussing partnership? We respond with the yes if we're able to see that. Are we together? Were we able to see that when you're discussing partnership? Perfect. Then you have additional non-allowable expenses for the company. We have what we call additional and say non-allowable expenses. Additional non-allowable expenses. Additional non-allowable expenses. What are these additional non-allowable expenses for the company? any form of dividends, any form of dividend. So we say any form of dividends, whether interim or final, we call it any form of what we call dividends. So any dividends that is paid to the partners, be it interim, be it final, those are non-allowable. Then for the company, we also call it all reserves. So when you see this, for example, in expenses, we have dividends paid or we have transfer to reserves. These are additional non-allowable expenses. So as a tax person, if you're to see this item on your income statement, then you'll basically add them back because they're non-allowable expenses. So then we proceed to what we call installment tax very fast. Installment tax. We'll proceed to what we call installment tax. We'll proceed to what we call the installment tax. We'll proceed to what we call the installment tax. So what is installment tax? Is it an additional tax? Is installment tax a new tax, additional tax? What is an installment tax? Would you classify installment tax as an additional tax? Sign. Would you basically classify installment tax as an additional tax? Is it an additional tax? Would you classify for the intermediate who just touched on it? Paid in advance, but it's not an additional tax. It's basically a corporation tax that is broken down. Are we together? Broken down in installment together. Are we together? It is not an additional tax. It's basically corporation tax. There's assumptions that are made on that. There's basically an assumption that is basically made on that installment tax. Are we together? But it's a corporation tax that essentially is broken down into 4 installments. That is for non-agricultural. But for the agricultural, when we talk about installment tax, agricultural companies, it's basically paid in 2 installments altogether. It is basically paid in 2 installments. So at the back of our mind, are we together? Not paid as a lump sum. At the back of our mind, we must agree that installment tax is not an additional tax altogether. So number 1, we need to understand not an additional. This is not what they call an additional tax. We need to understand at the back of our mind that this is not an additional tax, but a way limited company pay tax. A way, we call it a way limited companies, essentially a way that limited company pays its corporate tax, pays its corporate tax, call it for the year. So under administration tax and administration of income tax, that is basically on the intermediate, that is PFT, we talked about installment tax altogether, but bit of it altogether. We do not expand on it altogether. Are we together? We pay installment tax during the current year in installment. Are we together? So installment tax, we say is paid. How do you pay installment tax? Because we pay it before the end of the year. How do you basically pay installment tax? We pay it in advance. How do we now pay it? Because we pay this installment tax basically in advance. How do you basically now pay it? If you pay it, yes, quarterly, but based on assumption altogether. Because if you look at the current year, if you're paying the tax for the 2025, do you have income for the whole year? Do you have the income for the whole year? So basically do it based on assumption altogether. So basically saying that the previous year taxable income is going to improve by 10%. It is based on anticipation that the profit is going to improve by 10%. That's why you say we carry it based on 10% altogether. Are we together? Determination And then it is usually based on estimation. It is usually based on what's called based on estimation. Because if I was to ask you, how do I pay, for example, on total, how do I pay the tax for the current year, which is 2025? Do I have my total taxable income, Raphael? Do I have my total taxable income? No. So this is basically based on what's called estimation. And you're estimating based on the taxable income for the previous year, that this year is basically going to grow by 10% altogether. So we say it is based on 110%, 110%. We call it is based on 110%, 110% of what we call of the previous year tax paid. So it is basically based on 110% of what we call of the previous year tax paid for a continuing company. What we call for a continuing company. So if previously, for example, the taxable income was 100,000, either, what do you expect for the current year? The taxable income for the previous year. So we say 110. Taxable income for the previous year. So for the current year, what will be the taxable income? Now when you talk about the current year, you're saying that the growth rate is estimated to grow by 110. So it is basically we're saying that the previous year should now be 110%, 110,000. Kila mtu ameelewa? Kila mtu ameelewa. Raphael, tuko pamoja na wewe. Raphael? Are we together? So then we say it is determined as follows. Let me just wrap here. It is determined. We say that it is, call it determined as follows. It is determined as follows. It is basically determined as follows. So we have two categories. We have prayer break. What is the time? Okay. By 7, we should be back. Sawa. 7. Ida and the team, 7. 7 kindly. I'm back at 7, exactly 7. Sign, how many minutes? 5 minutes should be enough. Sign, is that okay? So we can start from there. So how to break installments? So we have what we call non-agricultural. When you have the non-agricultural companies, we have what's called the non-agricultural companies. So we have installment. We have what's called amount of the installment, and then we have what's called the due date. So if we've gotten the current year 110%, then we break it down. We have the first installment. The first installment, we have 25% of the total installment, and 5% of what we call of the total installment, and 5% of the total installment. When is it due? We have it by 20th of the 4th month, 20th of what we call of the 4th month, 20th of the 4th month in the year of income. of what we call income. So we call it the 20th of the fourth month in the year of income. So why do you say in the year of income? Because companies have different end of financial year, different end of the financial year. So then we have what's called the second. We have the second installment. So for the second installment, we also pay 25% of what we call of the total installment. We don't need to write. So this will be the 20th of the sixth month, 20th of what we call of the sixth month in what we call in the year of what we call income, in the year of income. Then you have what we call the third installment. So we have what's called third installment. The information is the same, but then you say the 20th of what we call of the ninth month in what's called the year of income. What we call the 20th of the ninth month in the year of income. So then you have what's called the fourth installment. So the fourth installment, again, that is 25% of the total installment. But we have it as the 20th of what we call of the 12th month, 20th of the 12th month. We call it in the year of what we call of income. 20th in the year of income. So then we have, at this point, after the 12th month, you now have the actual tax. Is that true? After the 12th month, now basically you have you now have what's called the actual income. After the year end, you'll now be able to determine what you call the actual tax payable altogether. It can be less or it can be more. Are we together? We respond with a yes. So I'll say that after the 12th month, now you'll have what's called the actual tax. Robert tuko pamoja. Now you'll have what's called the actual tax. You will have what's called the actual tax. So the final tax, that is a final tax. So the final tax we understand is based. This is basically based on what's called on the actual. It is basically based on the actual tax. So the final tax is basically based on the actual tax. Remember, these installments are basically estimate. These are estimation. So how are you going to get the final tax? So in that we'll have actual tax at the end of the year. Actual tax at the end minus what's called the total installment minus the total installment. So how do we get the final tax? Actual tax at the end minus total installment paid, say during what's called during the year, minus total installment, summation. Now this is the summation of those. Understood? Tafadhali munipatie yes kama tunaelewana. Munipatie yes kama tunaelewana. Benson tuko pamoja. Aida tuko pamoja. Aida tuko sawa. Benson, Sahin tuko sawa. Victor tuko sawa. Remember, teaching is a process, not just. So then we say that by 30th, this will be the by 30th of what we call of the fourth month. By 30th of what we call the fourth month. By 30th of what we call the fourth month. By 30th of the fourth month. After the year of income. After what we call the year. After the year of what we call of income. But master, this is what's called non-agricultural companies. These are non-agricultural companies. Yes, I will be able to do example and show you what happens. Are we together? I'll be able to do examples. Are we together? I will be able to do example and expand on that. On this actual tax, there's offense that actually can be here. Based on, as you do the example, I'll be able to show you what happens on both scenarios. On both scenarios, whether we have more or less. Is that okay? Benson, yes. So we can have a refund, or we can have a scenario where it's less. Are we together? Where it's less. And what happens when it's less? What happens when there's a refund? So as you get the example, we'll be able to do that. But mark the one. This is essentially for what we call non-agricultural companies. Non-agricultural companies. Is that noted? Is that noted? We respond to the yes. So then we proceed to the agricultural. What do you call the agricultural? We call them the agricultural companies. We call them the agricultural companies. We call it agricultural companies. So whenever we talk about the agricultural companies, whenever we talk about what we call the agricultural companies, let me adjust the board. Whenever we talk about agricultural companies, so for agricultural companies, we basically have what we call two installments. So we have two installments. We have two installments. If I have installment, so we have installment amount, amount, and then I have lastly what we call due date. We have what we call the due date. We have what we call the due date. Are you able to see the board clearly? Are you able to see the board clearly? So we have the first installment. For the first installment, we have the first installment. We're saying that 75% of what we call of the total installment. We have 75% of the total installment. We have 75% of the total installment. What is the due date for this? The due date is 20th. We have it as 20th of what we call of the ninth month. 20th of what we call of the ninth month. Are we together? Of the ninth month in the year of income. Then you have the second installment. Second installment is basically 25% of what we call of the total installment. 25% of the total installment. So when it comes to the second installment, we basically call it the 25% of the total installment that is paid on 20th of what we call of the 12th month. 20th of the 12th month. We say in the year of income. In the year of what we call in the year of income. 20th of the 12th month in the year of income. Tuko sawa. We give it a yes if you're together. If we are together, we respond with a yes. So final tax based on actual tax. We now have final tax. Final tax. You say based on what's called on the actual tax. Final tax based on the actual tax. The same concept. So we have the actual minus what's called the total installment paid. Actual minus total installment tax paid. Then we have it as 30th of what we call of the fourth month, 20th or 30th of the fourth month after the year of income. Call it after what we call the year, after the year of income. So we have it as 30th of the 4th month after the year of income. Tuko pamoja. Tubonyeze yes tafadhali. If we are together, we respond with a yes. We respond with a yes if we're together. Perfect. So then I want to talk about taxation of a related company. Taxation. We call it taxation. We have it as taxation of related companies. Taxation. Taxation of what we call of related companies. Taxation of related companies. That is subsidiary and parent company, joint ventures, how do you tax them? Associate, how together? Head office, and what's called and the branches. How do you basically tax this? Taxation of group-related companies, taxation of what we call the group, taxation of the group, stock related, group, stock what we call related companies, taxation of the group, stock related company. We have head office and the branches altogether. So companies are considered what they call group. We say if they are related. So companies we basically said they are considered to be group of companies if they are related together. If they're basically related. If they are related. Let me adjust what you have. Companies are basically considered group and say if they are related together. Either tuko pamoja, Benson, are we together? Companies are basically considered group if they're related together. Then you say that in case they're related, in case we say there's acquisition of shares, there is what we call acquisition. What we call acquisition of what we call of shares, and say among these companies. Among what we call these companies. If there is acquisition of shares, and say among these companies. So these companies are considered related if there is acquisition of shares among these companies together. Sain, do you have a question, Sain? He has just left. Tuko pamoja. Just respond to the yes if you're together, for those who are in. But when he comes back, he should be able. So when you say, how is it related? Sain, do you have a question? Sahin, do you have a question? If you have a question, give it to Mwalimu very fast before. Sain, do you have a question? Okay. So we need to understand that companies are basically related, we say, in the following ways. Companies are basically related in the following ways. So companies are essentially related in the following ways. Companies are related. So we have the first relationship. We just explained parent and what called and subsidiary companies. Parent and what's called subsidiary companies. For those who are doing FR, this should be, how do we call parent and subsidiary? So this is where a company does what? When you say parent and subsidiary, a company acquires what amount of shares? Parent and subsidiary. So we have a company acquiring more than 50%, say more than 50% of shares of another company together, of another company together. So this is where we have a company acquiring 50%, more than 50% of shares of another company. Rafael tuko Rafael tubonyeza yes. Benson, are we together? So that is a parent and subsidiary. We have a company acquiring 50%, more than 50% of shares of another company. Rafael and Benson, nipatie yes kama tuko pamoja. So in the second week, we have what's called a joint venture. We'll say a joint venture. Joint venture. We'll say joint venture relationship. So what is this relationship? We'll say joint venture. So this is 50-50 relationship. So a company acquires 50%, 50% of the shares of another company. 50% of shares of another company, shares of what we call of another company. So that is what's called a joint venture. 50% of shares of another company. Then we have the last one. We have what's called joint. We call it a venture associate. Venture associate relationship. So what is venture associate relationship? So when you say yes, 20 to 49, perfect. 20 to 49%. So less than 50, but above 20%. Above 20%. Tuko sawa. I want to give a very important so now in relation. So what differentiates this? So that is the point that will carry you in terms of taxation. Tuko sawa aida. Perfect. I want you to get this point. So in taxation, understand in taxation, we need to understand that companies' relationship is not companies' relationship is basically not considered. Are we together? So in taxation, companies' relationship is not considered. So if you have a parent company in a subsidiary, what does it mean? We tax them separately. Tubonyeze yes kama tuko pamoja. So in taxation, I basically say that company relationship is basically not being considered. Are we together? So each company should be taxed independently. So if you have a joint venture, are we together? If you own 50% of another company, those will be taxed separately. Are we together? So when you have a company and a subsidiary, they should be taxed independently. Nataka yes kama tuko pamoja. Onduto? Aida? Perfect. Thank you, Sahim. So each company is taxed independently. That is basically each company, we say is taxed independently. So each company basically is taxed independently and separately, and what's called separately. You say without considering there are shares, without considering their shares, acquisition among them. I want to teach you a very important concept about tax and about almost all the subjects. You see, what we're doing is the most important part of it. Understanding the logic. This is the most important part of anything that we're going to do tax, the background information. Tuko sawa. Tuko pamoja. The most important part is what we're doing here. Those calculations are just, but now we put what we've learned here. So then I go to head office and branch. Head office and branch. Lastly, we have the head office and branch. We now have what's called head office, and what's called in the branch. Head office and what's called the branch. So how do I tax head office and the branch? So understand that in taxation, when you're talking about head office and the branch, those are treated as one together. They're taxed together. So if you have head office and you have the branch, we combine the taxable income and we combine their allowable expenses to get what's called the taxable income. Benson, is that understood before I put it down? So head office and the branch, we tax them together. So if you're given the question, there's an head office and there's a branch, you need to understand that they are basically taxed the one and the same. And we tax them together. That we do not tax them separately. So these are not considered. These are considered not to be what we call a separate, entity. These are considered not to be a separate entity, entities, and therefore are therefore not taxed separately or independently. So they are combined. They are combined. They are combined. You say and taxed. We say taxed together. They are basically combined and taxed together. Point at all. So tumemaliza. I want us to go now to questions. I want us to move to questions. We'll respond to the yes if you together. I want us to move to questions. Perfect. So I want to go to questions, very important. But I've said and I've repeated, Victor, what is very important is what we're discussing in class. These ones are very important. What we're discussing, the question comes after this discussion. Are we together? So I want to do a question that basically combines related company, that is parent company and subsidiary, and we also have issues to do with head office in the branch. So I'll pick a very recent question, that is December 2024. That should be question. Open your December 2024. We have deck 2024. Deck 2024. Deck 2024. Deck 2024. Open deck 2024. As I get the paper, allow me to get deck 2024. Open deck 2024. I have a hard copy. Let me get it. 24. Yes, I have my paper. So that is question 2, question 2B. Question 2B. Question 2B. So give me a yes. Come on, Tuko. So are we on that question? We shall be open to give you extra questions, extra revision. That is what we were able to do on the last, especially ed, office, and branch, ed and branch. So are we on it? So perfect. So we mentioned that Ocean Limited is a holding company operating through operating 2 independent branches. So the branch is the ed office and worker branch, ed office and worker branch in located in different towns. So the company acquired 100% of Zurich. The company acquired 100% of Zurich in the year 2022. The following information has been provided to assist in determination of the taxable income. So the following information that we have down here has basically been provided to determine what we call the taxable income together. So allow me just to expound on that information. As we have that information, as a good student, I basically understand that worker branch, and the ed office are going to be taxed together. We say based on our analysis, based on our revision, the background information, I will understand at the back of my mind that the worker ed office branch and worker, those are Ocean. We call them Ocean Limited. So worker and ed, so worker, ed office, and ed office and worker branch. This is what's called the Ocean Limited together. So we combine, this is what's called Ocean Limited. Tuko pamoja. That is the Ocean Limited. So the ed office and the worker branch, this is basically equivalent to what we call Ocean Limited. That is what we call Ocean Limited. Tuko pamoja, we call it the Ocean Limited. So we're going to tax them together because that's the ed office and the branch. Robert, tuko pamoja? Respond with a yes, Robert, if it's together. Robert, respond with a yes if we are together. Respond with a yes if we are together. Yes. Who is this, my student called Robert? Are there 2 Roberts in this class? Is that Edema? Edema, have you joined twice? Have you joined twice, Edema? Edema, have you joined twice? No. Who is this Robert? Yes, maybe I will know that Robert later on. Are we together? So we proceed, but we understand that worker branch and the ed office are one and the same thing altogether. But now for the Zuri, we understand because it's a company, it's a subsidiary, then we understand that we're going to tax that one separately. So then we're being told that we're given the sales. We have the sales for the ed office to be equivalent to 800,000. We have the worker branch being equivalent to 148 million. Then finally, Zuri, we have it being equals to 280 million. Then you have what's called the cost of sales. So the cost of sales for the ed office, we have a figure of 123,678,000. For the worker branch, we have a figure of 73,890,000. Then finally, we have what's called the Zurich Limited. The cost of sales is a figure of 136,800,000. Then finally, we have what we call the gross profit. That is for the head office, there's a figure of 222,122,000. For the worker branch, I have a figure of 74,110,000. Then finally, we have a figure of 143,200,000. So then we have other incomes. So as we look at the gross profit, we need to ask ourselves, is gross profit a taxable income or a non-taxable income? Is gross profit a taxable income or a non-taxable income? When you have the gross profit, Sahin, is the gross profit a taxable income or a non-taxable income? Is the gross profit a taxable income or a non-taxable income? Is the gross profit a taxable income or a non-taxable income? So gross profit is a taxable income. We must agree that a gross profit is basically a taxable income. Gross profit is a taxable income. Gross profit is a taxable income. Perfect. So then I proceed to other incomes. So we have what we call profit from the sale of what we call marketable security. Profit from the sale of what we call a marketable security. So when you sell marketable security, is that a taxable income? Profit from the sale of a marketable security. Is that a taxable income? That is a non-taxable income. Securities, those are more capital in nature. So profit from the sale of marketable security, that is what we call a non-taxable income. Tubonyeze yes kama tuko pamoja. That is a non-taxable income. We have it as a non-taxable income. We have it as a non-taxable income. We have it as a non-taxable income. Give me a yes if you're together. Give me a yes if we are together. So give me a yes if we're together. Perfect. Perfect. So the next we basically say, dividends from Wezesha Cooperative Society. So we have dividends from Wezesha Cooperative Society. That is basically for the head office, a figure of 800,000, and we have a figure of 640, and the examiner tells us net. So whenever we say that this is net, this is less what we call withholding tax. That is less withholding tax. Tumelewana. So when it says net, we say less withholding tax. Unduto tumelewana. Perfect. So two things that I have here. Is that a taxable income? Dividends from Wezesha Cooperative Society. Is that a taxable income? Is that a taxable income? That's not a taxable income. However, when you say dividends from cooperative society, when you say cooperative society, it is not a taxable income in relation to a bill, because that's not a business income. Together, because that is not what we call a business income. Because that is not a business income. Are we in agreement? Because that is not what we call a business income. Because that is not a business income. However, it is an investment income. It is an investment income. Investment income that we subject. We say we subject to what we call to further taxation. That is subject to what we call further taxation. And whenever we subject it to further taxation, we're basically subjecting this further taxation at gross. Are we together? So we are going to less it first. We are going to less the figure, the net figure first. We are going to less the net figure first altogether. We are going to less what's called the net figure first. We are going to less the net figure first. Are we together? To get the business income, because that's not a taxable income in relation to business altogether. That's not a business income altogether, but that's an investment income. Have you ever seen people say rental income? Rental income is not a business income. What about altogether? I know that people practice rental income is not a business income. Are we together? However, it is an investment income that is subjected to further taxation. If you're doing business altogether, you're going to add it as other incomes that is subject to further taxation. So then we proceed to the next. We have what you call dividend. We have what you call interest from a bank. Interest from a bank. Interest from a bank. So there are two concepts here when you talk about interest from a bank. Yes, interest from a bank. How do you treat interest from a bank? Interest from a bank. 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 Victor, is that a taxable income in relation to business? That's what I wanted to teach. So this, basically, when you have this, when you say interest from a bank, we call this is a non-taxable income. Non-taxable, taxable income in relation to B. We say in relation to what we call to the business. This is what we call a non-taxable income in relation to the business, in relation to the business, together. However, there are two things here, and I want you to understand that. There's interest that is received by individual from a bank. Individual from a bank. If an individual receives interest from a bank, we call it, this is a qualifying. We call it qualifying in interest. And don't forget what I'm teaching today. If an individual receives interest from a bank, individual receives interest from a bank, and we say interest from bank and insurance company, we call it qualifying interest. The 15% withholding tax is final. But mark the word. This is who? This is an individual. Tuko pamoja. Mark the word. That is an individual. We respond with a yes either. Mark this. This is an individual. If an individual receives interest from a bank, we call it qualifying. Basically implying that the 15% withholding tax is final. However, if a company, look up, we're not talking about companies. Company receive interest from a bank. Would it still be qualified? If a company receives interest from a bank, if a company basically receives interest from a bank, if a company receives interest from a bank. So how would you call it? If a company receives interest from a bank, we call it non-qualifying interest. There's a difference between those two. We call it non-qualifying interest. So if what we call a company receives interest from a bank, it is non-qualifying. In this case, this interest is non-qualifying. Are we together? So in relation to business is a non-taxable income. However, on other incomes, we are supposed to add. Are we together? We are supposed to add. We are supposed to add it back. So that is because it is a company receiving interest from a bank. Together. So we're going to less, but add it again because it's a non-qualifying interest. Tafadhali tubonyeze yes kama tuko pamoja. Kuna mtu elewi kitu yote? Kuna mtu ako nje kidogo na nasema mwalimu rudia. All of us, are we there? A yes would be very appropriate for us. Benson, uko na mimi? Sain, tuko sawa? Thank you if you're together. So then we go to total income. We have the total income. That should be okay. So then we go to expenses. Look up expenses. On the expenses, I need my student to understand. On the expenses, I need you to understand what I call allowable and non-allowable expenses. Allowable and non-allowable expenses. Tuko pamoja. On the expenses, I need us to understand allowable and non-allowable expenses. And I believe somebody was not understanding why, when I was starting advanced tax, these were concepts that I was talking about. Did I talk about those concepts before I started the advanced taxation of partnership? For those who are following the video, I used in this concept that were discussed in order. I started with capital allowance. I talked about capital allowance. I talked about investment income. I talked about allowable and non-allowable because I know. Are we together? The students who would come to this class and they did not cover allowable and non-allowable, and it becomes something else. So then I start with the repairs and maintenance. So for the head office, I have a figure of 17,400,000. For the branch, I have a figure of 3,850,000. And for the Zuri Limited, I have a figure of 8,900,000. Is that allowable expense or non-allowable expense? Is that allowable expense or non-allowable expense? Is that allowable expense or non-allowable expense? So that we are in agreement is allowable expense, unless otherwise. So then we have the next, which is called finance charges. We have 20,700,000. We have 12,650,000. And finally, we have the Zuri, a figure of 7,560,000. So how do you treat the finance charges? Are those allowable expense or non-allowable expense? Finance charges, are those allowable expense or non-allowable expense? Those should be allowable expense. So then we proceed to what we call legal fees. How do you treat legal fees? Legal fees. Yes, the things that I have remembered to teach you. So legal fees. So if there's not a legal fee, they can be allowable, or non-allowable. So we basically say that this is subject. We call it subject to additional information. So this is basically subject to additional information. Subject to what's called additional information. Are we together? Yes, that's okay. This is subject to additional information, because the legal that we say are allowable, but at the same time, the legal fees that are non-allowable. The legal fees that are allowable, but at the same time, the legal fees that are non-allowable. Tafadhali nibonyeze yes kama tuko pamoja. Tafadhali bonyeza yes kama tuko pamoja. However, if you're given legal fees and there's no additional legal fees and there's no additional information, how would you treat it? Information. How would you treat it? If you're given a legal fee and there's no additional information, we treat it as allowable expense. Together, we treat it as allowable expense, not a yes. Same to, for example, you're given dividends. Dividends, we say from cooperative society. And you're not told whether it's net or gross. You're basically told whether you're not told whether it's net or gross. How would you treat it? Would you treat it as gross or net? Would you treat it as gross or net? Would you treat it as gross or net? Let's say, for example, you're given dividends from cooperative, so we'll treat it as gross. Again, we also understand, for example, we have things like foreign exchange gain. When you have an income like foreign exchange gain. But in taxation, we basically say when you have foreign exchange gain, it has to be realized. When it's realized, that is when it's a taxable income. When it is realized, that is when we have it as a taxable income. When it is realized, we have it as a taxable income. However, if you're told unrealized, then that is a non-taxable income. If you have a question, there's foreign exchange gain and there's no additional information, how are you going to treat it? We are going to treat it as taxable, if no additional information. If there's no additional information, we are basically going to treat it as a taxable income, We are going to treat it as a taxable income. Yes, you see, when you say unrealized, that is estimation. When you say unrealized, that is basically estimation. How is this respond if you're together? Yes, unrealized, we have not received that. That is basically estimations. Sawa. So in taxation, we don't allow that. Tuko pamoja. How much time do we have? So the next we have what's called depreciation. How do you treat depreciation? So depreciation, we have a figure of 93,45,000. That is 9,345,000. Then we have what we call worker, 5 million. Then we have 11,890,000. That is for Zuri. So how would you treat depreciation? That would be non-allowable expense. So for the depreciation, we are going to treat it as a non-allowable expense. Because of time, we meet on Sunday, but we're on the right track. On Sunday, we'll meet on Sunday. I hope we enjoyed advanced taxation. Are we enjoying this class? Yes, if you're enjoying it, then we tell other people to join. We remind our friends to join it. Are we together? I want us to enjoy it and remind others. And I want you just to be very keen. I will teach you two things. If I teach those two things, how to master entries and how to manage time. Those are the only two things that I'm always scared of. How to manage entries and how to manage time. Not perfection. I don't expect anybody to be perfect. I don't expect anybody to get these sums as I get them. Are we together? But once we know how to manage our time, Benson, two things. How do I put the entries and how do I manage time? And understanding the concept, only that. I don't teach you to be perfect. Thank you. God bless you. Unless somebody has something that is burning, but I beg to close it there. God bless you. Continue supporting Focus. Yes.